The Income Tax Act is the rulebook for taxes in India. It tells us how much of our income we must pay to the government. That money funds roads, hospitals, defense and government salaries, the financial backbone of the country. Think of it as the country's backbone. Every salaried person, every business owner and every investor is affected. The old act, written in 1961 and patched for decades, became a labyrinth. Even experts struggle with it. So the government proposed a brand new Income Tax Act, a complete rewrite. The aim, make taxes simpler, close loopholes, and adapt to a digital economy. 60 years ago, we didn't have UPI, gig work, or complex financial products. The new act aims to catch up. If done right, compliance becomes less of a headache. But big changes raise big questions. Let's dive in, piece by piece. The old act was built on deductions and exemptions, ways to lower taxable income by investing or spending in certain ways. Section 80C was the most famous, up to 1.5 lakh rupees. PPF, life insurance premiums, ELSS, all reduced your taxable income under 80C. That subtraction was a powerful nudge for long-term saving and investing. Salaried people got a standard deduction of 50,000 rupees, a flat reduction, plus allowances like HRA and LTA, tax-exempt if conditions met. Businesses could claim depreciation on assets, encouraging investment in machinery. Investors enjoyed favorable long-term capital gains rules. Listed stocks taxed at 10% above Rs 1 lakh after holding. In short, the old act used deductions as policy tools to promote housing, savings, investment, and insurance. Tax planning became a strategy taxpayers used every year. Now see what the new act changes. The heart of the proposal is radical simplification of slabs, fewer rates and generally lower peak rates. For example, income between 5 and 10 lakh could drop from 20% to 15%. But to get lower rates, you give up almost all deductions and exemptions. That's the trade-off. This is the grand bargain of the new system. Section 80C and its 1.5 lakh limit may be removed. The standard deduction of Rs 50, 000 and HRA exemption are proposed gone. Capital gains rules may be standardized. Same holding period, same rate across assets. Possibly a single 2-year holding period and removal of the Rs 1 lakh LTCG exemption for equities. For businesses, the move is toward a single lower rate and phasing out special exemptions like accelerated depreciation. Tax will be calculated on a profit closer to actual cash profit. More transparent, but possibly higher tax for some firms. Simpler rules, but many familiar benefits will disappear. The most painful loss is Section 80C. The government nudge for saving could vanish. PPF, EPF contributions, ELSS, life insurance premiums, all lose preferential tax status. HRA exemption removal will hurt salaried employees in high-rent cities. Someone paying Rs 25,000 a month could lose over Rs 50,000 a year in tax savings from HRA. Deduction on home loan interest under Section the 24th of May be removed, making EMIs effectively costlier after tax. This shifts the real estate equation for both renters and owners. Deductions for health insurance, ATD, and LTA may be removed, reducing incentives for protection. The system moves from a tailored suit to a one-size-fits-all t-shirt. Simplicity comes at the cost of flexibility. Many will have to rework family budgets and long-term plans. Long-standing policy instruments that encouraged saving would be removed. Who wins? Primarily high-income earners who did not use deductions, young professionals living with parents, and people with simple finances. If you have no home loan, no HRA, and don't invest in 80C instruments, you may pay less tax under the new slabs. Example: a young professional, Priya, living with parents and investing in foreign stocks or crypto. Lower slabs can more than compensate for lost deductions. Her net tax falls. No need to track proofs. Good for people without advisors or those who find deductions a hassle. Young entrants and those with straightforward incomes win from reduced compliance. More disposable income may boost consumption. Retailers and service sectors could benefit. Overall transparency helps taxpayers know exactly what they owe. In short, flexibility and simplicity are the winners. The biggest losers are diligent, conservative savers, the salaried middle class. Those who relied on HRA, home loan interest, and ATC deductions face higher taxes. Example: Rohan, earning Rs 15 lakh, pays high rent, uses ATC fully, and buys health insurance for parents. Under the old system, his taxable income dropped a lot. Under the new, it doesn't. His final tax can rise substantially. Real estate demand may soften. Loss of home loan interest deduction reduces the tax incentive to buy property. Insurance companies and tax-saving mutual funds may see lower inflows. Without incentives to save, households may spend more or move into riskier investments. That can shift money away from stable long-term instruments to volatile markets. Single-income families and many women who built small safety nets using tax instruments will be hit hard. Removing incentives risks undermining disciplined saving for those who need it most. The new act affects national savings, financial institutions, markets, and long-term investment. If household savings fall, domestic capital available for infrastructure and bonds could shrink. Insurance companies and asset managers that relied on tax-driven product demand face a business model shock. Expect consolidation and product redesign toward intrinsic value, not tax benefits. If LTCG perks are removed, equities lose a retail advantage. Retail inflows could slow. Domestic flows that help stabilize markets may reduce, increasing volatility or reliance on foreign flows. Lower taxes could boost consumption and short-term GDP growth. A simpler code may attract FDI and improve ease of doing business. But it's a trade-off: higher consumption versus weaker long-term capital formation. Which wins will decide India's long-term trajectory. Meet Anjali, 28, graphic designer, lives with parents, invests in global stocks and crypto. Meet Samir, 40, marketing manager, rents in Mumbai, invests in PPF, pays health insurance and school fees. Both earn Rs 18 lakh. Under the old system, Anjali's taxable income used a standard deduction, but she didn't use ATC much. Under the new slabs, even without deductions, her tax falls. She wins. Samir used HRA, ATC, and ATD. His taxable income under the old act was much lower. Under the new act, his taxable base rises to Rs 18 lakh and his final tax increases. He loses. Side by side, Anjali pays less, Samir pays more. Same income, different life choices. The outcome depends on life stage and choices. Key lesson: simplification helps the unencumbered. It hurts those who planned finances around incentives. Which act is better? There is no single answer. It depends on your priorities. If you value simplicity and lower rates, the new act wins. If you value directed incentives for savings, the old act wins. Policy is a trade-off: spur consumption and ease versus secure long-term domestic capital formation. An ideal path keeps simplification but retains core incentives for housing, retirement, and health protection. If the new act passes, individuals should recalculate tax, rebalance investments, and review insurance and retirement plans. Simple steps: run a tax comparison, check monthly cash flow, adjust SIPs and EMIs accordingly. The new proposal creates clear winners and losers and redraws the financial landscape. If you found this useful, run the numbers for your family and subscribe for the detailed calculator video we'll release next. Thanks for watching. Stay informed and plan ahead.